2008, the collapse that shook the world. The world didn't end in fire, it ended in numbers, and no one saw it coming. In 2008, the world faced a disaster not born of war, nature, or plague, but of ambition, greed, and a system built on illusion. It was the collapse that changed the global economy forever. A crisis so vast and invisible that its tremors still shape lives today. It began quietly. No explosions, no sirens, no smoke. Just the hum of computers, the sound of trading floors, and the false calm of prosperity. For years, banks, corporations, and investors have been feeding an unstoppable machine. A machine powered by money that didn't really exist. To understand the crisis, we have to go back. Back to the 1990s, when the American dream was for everyone to own a home. Banks began offering mortgages to almost anyone, even those who couldn't afford them. These were called subprime loans. Risky, unstable, but highly profitable. The more they lent, the more money they made. Wall Street didn't care if people could pay them back. They just kept selling the dream. Soon, these mortgages were bundled together into complex financial products called mortgage-backed securities. They were like bombs wrapped in gold, shiny on the outside, toxic inside. Credit rating agencies, supposed to warn investors, stamped them with AAA ratings, calling them safe. That lie became the foundation of a trillion-dollar empire. Investors around the world, in Europe, Asia, the Middle East, poured their money into these securities. Everyone wanted a piece of the American housing boom. The world economy became entangled in a web of risk that no one fully understood. By 2006, warning signs began to flicker. Home prices were skyrocketing beyond reason. Families took out loans they could never repay. When interest rates rose, monthly payments doubled or tripled overnight. Foreclosures began, one street, then one neighborhood, then entire cities. But still, Wall Street celebrated. They believed the market could never fall. They believed in an endless climb. They were wrong. By 2007, the first cracks appeared. Small banks began to fail. Hedge funds collapsed. The term liquidity crisis entered the headlines. But the public didn't panic. Not yet. Most people didn't understand how close the system was to imploding. Behind closed doors, inside skyscrapers in New York and London, panic was spreading. Executives realized the securities they had sold were worthless. The loans that fueled them were defaulting faster than anyone had imagined. The paper wealth that had defined the global economy was vanishing, billions, then trillions, disappearing into digital dust. In September 2008, it all came crashing down. Lehman Brothers, a 158-year-old investment bank, collapsed under the weight of $600 billion in debt. Overnight, one of Wall Street's oldest institutions ceased to exist. Its fall sent shockwaves through the financial system. Stock markets plummeted. Credit froze. Confidence, the invisible glue that holds economies together, shattered. The next morning, ordinary people around the world woke up to chaos they couldn't see, but would soon feel. Jobs vanished. Retirement savings evaporated. Businesses closed. Government stepped in, trying desperately to stop the bleeding. The term "too big to fail" became the moral debate of the century. In Washington, meetings ran through the night. Treasury Secretary Henry Paulson, Federal Reserve Chairman Ben Bernanke, and others gathered in panic. They debated, should they let the free market correct itself, or should they intervene and save the banks? Either choice meant catastrophe. They chose intervention. Hundreds of billions of dollars were poured into bailouts. The U.S. government effectively bought stakes in collapsing banks. Across the Atlantic, the United Kingdom did the same, nationalizing giants like the Royal Bank of Scotland. It was the largest transfer of public money into private hands in modern history. But to many, it felt like betrayal. Ordinary citizens lost homes, jobs, and hope. Yet the same institutions that caused the crisis were being rescued. The anger that followed reshaped politics for years to come. And yet, the story wasn't over. The crisis spread beyond America's borders. In Europe, countries like Iceland, Greece, and Spain faced economic ruin. Iceland's banking system collapsed entirely. Greece's debts spiraled out of control, leading to austerity and public unrest. The European Union teetered on the brink of disintegration. The global economy was interconnected, and that meant the damage was universal. Families who had never set foot on Wall Street lost their life savings because of what happened there. Students graduating in 2009 entered a world with no jobs waiting for them. Entire generations were scarred by the consequences of decisions made in boardrooms and trading floors far beyond their reach. The housing bubble was gone, but the lessons? Still ignored by many. After 2009, the rebuilding began, slow, uneven, uncertain. Interest rates were cut to historic lows. Governments introduced new regulations, like the Dodd-Frank Act, to prevent such a collapse from happening again. But the scars were deep. The system had changed forever, and so had trust. Behind the technical terms, derivatives, credit swaps, liquidity injections, lay a simple truth. Human greed and blindness nearly destroyed the global economy. It wasn't computers that caused it. It wasn't algorithms. It was people. People chasing profit, ignoring warning signs, believing they were untouchable. Documentaries, books, and films, from Inside Job to The Big Short, would later reveal how close the world had come to total collapse. But for those who lived through it, no dramatization could capture the fear of watching everything crumble overnight. There were suicides among traders who lost fortunes. There were families who never recovered. There were nations that would take decades to heal. The 2008 crisis wasn't just a financial event. It was a mirror, showing the fragility of a system built on confidence, and how quickly that confidence can vanish. Even today, echoes remain. Cryptocurrencies, inflation, housing markets, they all bear traces of what happened then. Governments print money, investors speculate, and the same question lingers. Have we really learned anything? History may not repeat itself, but it often rhymes. The world's dependence on debt and speculation continues. The tools are more advanced, but the behavior remains the same. Every boom carries the seed of its own collapse. In the end, the 2008 financial crisis wasn't just about banks or houses. It was about belief. Belief that markets could regulate themselves, that numbers on a screen were real wealth, that greed could be controlled. When that belief shattered, so did the illusion of endless growth. As one economist later said, "We built castles in the sky, and then we were shocked when gravity took them down." Today, the lessons of 2008 remain a warning. That unchecked ambition can destroy lives. That the most powerful forces in the world are not natural, they're human. And that trust, once lost, is the hardest currency to recover. This is the story of 2008, the year when the world's financial system came to its knees. The year when silence fell on the trading floors and the numbers stopped making sense. The year when millions lost everything except the memory. Because in the end, money can be printed again, but trust, once broken, may never return.